Well, hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to my weekly show here on StockCharts TV. Great to be with you today here on Monday, especially after a pretty painful Friday for investors. Market sold off pretty aggressively on Friday. I feel like for a lot of investors, it was sort of a wake-up call, a friendly reminder, a public service announcement that the market can and actually often does not go up, actually goes down. And for a lot of investors, positions that have been just fantastic stocks that have logged so many great gains off the April low, all of a sudden down quite a bit in percentage terms on Friday, right? It was a challenging day. Now Monday so far we're kind of rallying off of the out of the open, which is good. But overall, I think the damage was done mentally for a lot of investors. So today we're going to talk. I thought it'd be appropriate, given that sell-off on Friday, great to talk about using technical analysis and the StockCharts platform for risk management. For me, managing risk is all about protecting yourself from capital loss. And I would say part of that, I mean, this is a whole day-long, event we could put together of managing risk using technical analysis. Has a lot of different parts to it, right? It has, it's money management skills. It's things like position sizing, making sure you don't have too big of a bet. It's trimming positions on the way up to make sure that you're, keeping proper allocations. It's, using stop losses and using protective trading strategies, using the options market, right? There are a lot of different ways we can try to protect ourselves from capital loss. But at the end of the day, in my experience working with institutional investors and financial advisors and individual investors, at the end of the day, it's all about recognizing when the evidence changes, right? There was some reason why a stock like a Home Depot or Palantir or NVIDIA or Oracle or whatever that stock is that you remember buying and working. I'll take you on the Wayback Machine. XMSR, XM Satellite Radio. This is before they merged with Sirius Satellite Radio. And in the early 2000s, I remember thinking satellite radio seemed like a promising technology. I remember buying XMSR and bought it pretty low, probably in like the $8 to $10 range. And eventually it rallied to 20, 30, and probably a little bit above there. And I remember sitting there looking, at my account and thinking like, this is awesome. I mean, like, I just need to keep doing this over and over. And this game is easy. And I remember thinking how important that position was. I mean, it was just such a great example of where I'd gotten everything right. And sure enough, you can probably follow through what happened next. Eventually, XMSR stopped going up, started rolling over. And instead of looking at the evidence and saying, all right, XMSR is no longer a great chart, I should be taking some off the table, or I should be selling my position, I didn't. I held on to it because of my emotional attachment to that position. True story. You actually do develop emotional attachments to your positions, whether or not you openly acknowledge that or not. It happens. And it's a well-documented behavioral bias called the endowment bias or the endowment effect. We basically, don't take action. We don't sell positions when we should because of our emotional attachment to those positions. So today we're going to show you some tools on the StockCharts platform to help minimize the negative impact of the endowment bias. For me, I have found it's all about having a regular routine, a regular process for reviewing your positions and looking for signs of weakness. We'll talk about an indicator that can help you sort of anticipate a potential top in a position that you own. We'll talk about a number of ways to validate that a chart is no longer bullish. We'll look at some recent examples of stocks that just came up on the screen today when I ran it to look for stocks that may be rotating lower. I hope that you find this helpful. And with that in mind, we'll get to the three charts. I did a scan a little bit ago, and at the end of the episode, make sure you stay tuned because I'll show you the scan that I ran and how you can actually automate it to run on your watch list or your portfolio every day, every week, and just make sure you don't miss one of your positions starting to show some serious signs of technical deterioration. We're going to start with Outfront Media. This is a $3 billion market cap stock within the communication services sector. So the stock has actually been doing quite well coming off of the April low, right? April low as the S&P and the NASDAQ were hitting a bottom second week in April, hit a support around 1250. Eventually recovered. Hasn't quite been a double off of that low, but has certainly, aggressively moved toward the 1950 level, which is where it actually peaked out in August. Then we basically had a retest of that previous peak here in September, around 19 and a quarter. Note how those line up very well with the high that we had back here before the sell-off in Q1, right? So November of 2024, right around that same point. Now what's happened is we've rotated lower. Now, a lot of times when stocks have an initial sell-off, I often get questions on how do you differentiate sort of a garden variety brief pullback within an uptrend, right? The type of pullback you probably want to be buying versus something that's more significant and more negative. Today we're going to talk about some of those technical ways we can validate it. So let's start with sort of the early warning systems. What are the techniques you can use on a chart like Outfront Media to anticipate the fact that we may be nearing a top? For me, the best way to do that is to think about divergences, right? When a stock is in an uptrend and it's a healthy accumulation phase, right? When the chart is going higher and it feels like there's plenty of decent momentum behind that move, the RSI, which is my favorite measure of price momentum, should be continuing to increase. And particularly as we make new highs, those new highs, the RSI should reach an overbought region. What you want to start to be skeptical about is when the price keeps making new highs, but on weaker momentum, right? As the RSI is no longer overbought. If you look at the left half of the chart, you can actually see a couple examples of that bearish momentum divergence, as we'd call it, in practice, right? Here, short-term version coming off of a June 24 low. We made a new high, a new swing high in July. We became overbought. We made an even higher high at the end of July. We're not overbought. So higher prices, weaker momentum suggest an exhaustion to that uptrend, and we see a pretty significant pullback from around 15 down to around 13 just in about a week. Then we resume the uptrend. We're making new highs. We're overbought again. That's good. All of a sudden, we make another new high. We're almost exactly at the overbought region. And then here's a new high around Thanksgiving of 2024, and we're not overbought. So look, each new high marked by weaker momentum, that implies that we're near the end of that uptrend phase. And sure enough, that ended up being the peak at the end of November before a rollover that ended up accelerating into the April 2025 low. Now, fast forward off of the April low, we keep getting stronger. Momentum keeps getting stronger. Finally, July peak, we're overbought. August peak, we're not overbought. September peak, we're even lower. So what you have to remember, right, just because we have a divergence, I don't think of that as much as a timing tool, right? I think for me, that tells me the conditions are similar to previous tops. This should go on a watch list. If I have a position in out, which I don't at the moment, but if I did at that particular time, I would probably put it on a separate chart list that it's my positions that may be nearing a major peak, right? Ones that I want to make sure that I follow very closely. I don't want to become complacent on those names because those are the stocks that may be nearing a potential top. So what I want to do is then progress into the other set of tools we're going to talk about, which are things that would validate the fact that, yep, that was a top and we're rolling over. The deck was kind of stacked against Outfront Media at the beginning just because this action in July, August, and September was taking us back to a pretty significant peak. So like on the weekly chart, you can see that that's a pretty major level of resistance, right? So we can tell that, the chances of us just blowing to new highs and ignoring that resistance may be lower than average. And so, not unreasonable to expect some sort of deterioration. Also on the daily chart, if you know your candle patterns, that's a big shooting star candle, which is when the open and close are near the lows. Big upper shadow, limited lower shadow. So the first time we kind of retested that resistance, we had this big bearish candle pattern. We had another one here when we tested the peak around 19 and a quarter again. So we had some kind of bearish candle activity, which often is helpful for recognizing that the price may be finding resistance. But look at what happened in the last month with the chart of Outfront Media. And let's talk about some of the technical signals that did not hold, right? I always say that in a bullish uptrend, holding above the 21-day exponential moving average at the very least is an easy way of just making sure that you're sticking with trends as long as possible, right? And if you have a position, an active long position, I always will keep an eye on that 21-day EMA just for peace of mind, right? Because the way you think of it is until and unless we break the 21-day EMA, things just aren't getting that bad. Anything above there is probably normal noise, nothing to be concerned about. But if we break the 21-day EMA, I need to be aware of that. And that's what we found here in early September. Didn't go much lower. Saw that again late September, where obviously we have gone lower. If you break the 21-day EMA, the 50-day moving average is where you often can rely on support. And holding the 50-day moving average, I found, has been a fantastic way of just validating short-term garden variety pullbacks with something more significant. So we held the 50-day in May, in June, in July, but here finally in early October, we no longer held the 50-day moving average, which tells me, all right, this is something a little bit more consistent. Now, what else can we do on this chart to sort of understand the fact that the character has changed from an accumulation phase to what's more better described as a distribution phase? Well, I would say, trend lines still work, right? So just drawing a simple trend line off of a major low, and again, where we draw that trend line could be a subjective exercise, right? You may draw it using, some of these lows. You might draw it a little less steep using like this major low. But wherever you draw a trend line, it's definitely been broken. Whether you drew a really steep trend line off those initial lows, that broke back here. But if you drew other trend lines using some of these lows in June or August, like we've broken all of them. So regardless of where you drew a trend line, regardless of how closely you monitored the uptrend, that it's been broken. And when I'm often try to think about what's the right trend line to use, not to digress, is I often do a parallel one. So if you find a trend line that kind of works, do a parallel line. And you see how when I do a parallel line to this one, it matches pretty well, kind of the highs. Now I can understand that this entire rally is sort of an uptrend channel, right? Where we get to the upper end, we get toward the lower end, and we're just sort of bouncing between those extremes. And again, it reinforces the fact that this move in the last couple weeks has been a clear departure from the pace of the uptrend that we've experienced off of the April lows. So that's one way to think of it. We obviously broke the 50-day moving average. That's another way to think of it. Momentum matters in a big way. Look how the RSI in a bullish trend tends to drift higher, right? So in a bullish trend, the entire range of the RSI tends to push higher. We become overbought on rallies. On pullbacks, we don't get much below 40. And you can see that happened here in June and August, right? The RSI held 40, which told you this is probably more of a pullback within a longer-term uptrend. More recently, though, we broke down out of the channel. The RSI is broken below 40. So all of a sudden it looks very different than the June low and the August low, right? Here we held the 50-day moving average. RSI holds 40. Here we break below the 50-day moving average. The RSI does not hold 40. So all of a sudden it feels very different. The other thing we can do, and we'll have a couple more examples to kind of put these all together, is I love using something like the Chandelier exit system. I always tell people, right? I mean, there are a lot of different ways we can use, trailing stops of different sorts. But for me, the Chandelier exit system, which is really popularized by Dr. Alexander Elder in his books, is based on average true range. And what that does is it's a dynamic stop based on the true range or the average movement, just the daily fluctuation in a stock price. And by using the average true range as a main input into your trailing stop, if the stock's more volatile, your stop is wider to accommodate the normal volatility. If a stock has sort of a lower daily range, the stop gets bumped in. So it's a dynamic stop based on the normal volatility that a stock experiences. So you want a stop that's triggered if and when the price is more significant, more painful than normal. All right, here we can see the Chandelier exit system. See a couple times where it actually broke here in July into August, but the real signal here more recently over the last week, finally breaking below that Chandelier exit for a long position. So what does all this have to do with endowment bias? Well, the reality is, if you own a stock like Outfront Media and you bought back here, you're feeling like a rock star stock picking genius all along the way. And what happens is, as the stock rises, as your confidence grows, it tends to become a little more overconfidence, and we almost assume that the stock can't go down, right? It's just going to keep going up forever, and it's going to be our best position in the history of our investing life. And because of that, because of our emotional attachment to that position and what it means for us, when the price actually rotates lower, we don't take action, right? So if the chart makes sense, if it deserves a position in your portfolio because the technical configuration is positive, so be it. That's great. That's what we want to have a portfolio look like. But we also have to remain ready and willing to take action when a stock no longer deserves a place in our portfolio. One of the portfolio managers I used to work with at Fidelity back in the day, I always used to say, think of positions as things you don't buy, but you're renting them, right? Even though you own a position in the stock, you own a position in the company, there are responsibilities related to that. That's all, that's all fine. That's all separate. But just in terms of how you think about it, right? You are renting this position, which means when it's no longer serving your purposes, when it's no longer helping your investment goals, when it no longer justifies having a spot in your portfolio because the technical picture has changed, get out of the way, right? Exit it, be done, and move on to a better opportunity. So the way that you fight endowment bias, to put simply, is have a consistent process of reviewing the evidence and making sure that strong charts that you own aren't turning into less strong or outright weak charts. We outlined with the chart of Outfront some of the specific things that we found. Let's look at two other stocks that came up in that screen. I'll show you how that relates to the toolkits that we've talked about. And then I'll show you how you can actually automate a screen using the StockCharts platform to make sure you don't miss the next rollover in a stock that you own. Here's another one, Buckle, BKE. This is an apparel retailer, which is in the consumer discretionary space. Let's talk about some of the different technical configurations we noticed in the previous chart and how that relates to what we're seeing here. So off of the April low, very similar. Higher highs every month. We can see that new highs in May, in June, in July, in August, in September, all becoming overbought. That's pretty good. But we did see a divergence back here, totally fair in May and June. A bit of a warning sign going into that June, mid-June region. Overbought, then not overbought. Never really, turned into anything very negative. We held the 21-day EMA, so I think that's a warning sign that didn't really turn out to be that bad. Fine, great. We'll continue to hold the position. We keep holding the 21-day, we finally don't hold the 21-day EMA. RSI diverging from price, so higher highs in price, weaker peaks in momentum. Now we've broken the 21-day. Now we're breaking the 50-day moving average. The RSI, which was well above 40, even well above 50, even 60, May, June, July, August, September, all of a sudden breaking below 40. So all those things we talked about on the previous chart all rolling over. Let's throw the Chandelier exit system on here. Right, so look how it held the Chandelier exit all the way up. You're good, you're good, you're good, you're good, you're good. You're finally not good, right? So something like the Chandelier exit system I found so valuable because what this does is it eliminates kind of the guesswork of it, right? I mean, the idea is when that triggers, you move on, right? You don't question it. You don't second guess it. You don't think about, well, do I really want to follow the stop today? You just unwind. I was taught all large losses begin as small losses. So let's keep our losses small, get out of the way, and avoid holding this thing as it retraces all of the previous action. So could Buckle find support here and just make a big V bottom and rotate higher? For sure, it absolutely could. But do I feel better recognizing when a winning chart that I own for a particular reason is no longer the case, and at least taking some of that position off because it's no longer justified by the chart? 100% I feel good about that. That's what you have to remember, right? I mean, these sort of risk management approaches doesn't guarantee you're going to always buy and sell at the optimal time, but it will absolutely help you avoid climactic losses and avoid holding things on way too long. And when you sell too late, right, if you're selling after the peak way too late, that usually has something to do with endowment bias, with your emotional connection to that particular position. All right, final one, GPC, Genuine Parts. This is an auto parts company. Of course, kind of you can see some of the similarities to the previous charts. We're in an uptrend phase. In this case, we had a sort of a secondary breakout in July, taking us above some of these significant resistance levels, really initiating a new uptrend phase. We see some pullbacks to the 21-day EMA, then we finally see that start to break. In the last week, we've broken through the 50-day moving average. The RSI has broken below 40. As with any of these, right? I mean, if I draw a trend line off of the major lows, you'll see how it's pretty, again, regardless of how you drew the trend line, it's broken, right? And so, when you have a position that's working, and I would assume many of you, if you've been owning U.S. stocks, a lot of your charts probably, hopefully, have looked like this for a while. Don't neglect just drawing major trend lines off of the significant lows, just following those signals and just making sure I want to make sure I, hold it as long as it holds the trend line. But if it breaks, then I may need to just revisit that position. So 3 examples, out, BKE, GPC, all rotating lower here in the last week, all instead of having an actionable pullback to like a 21-day EMA or even finding support at the 50-day moving average, broke through all those levels. I would argue the way that you avoid endowment bias is by having a regular process to look for charts in your portfolio or on your watch list that are breaking down, charts that show what we describe as a change of character, right? We have a certain configuration that's now changing, and then just make sure you take action. At the end of the day, it's all about you actually taking action on the charts. As one of my mentors, Ralph Akinpour, used to say, analyzing the chart's the easy part. Actually doing what the chart's saying, that's the tough part. So how can we use the StockCharts platform to automate this sort of thing? Well, first thing what I would tell you is you want to make sure that you use the alerts functionality, you use the scans, you use the chart list. Those are the 3 tools that I use regularly to avoid endowment bias. Number 1, with your chart list, right? And again, I'm not a perfect example because a lot of my chart lists are designed so I can show things on the screen. But for example, if I have a brokerage portfolio, I would have a chart list with positions that I'm actively managing, just the ones that I want to make sure I've identified buy and sell points, I've identified levels of risk, I have a clear idea of what would tell me something's broken. If I have a bunch of positions, if some of those start to show some of the early signs of deterioration, as we've outlined earlier in today's video, I would create a separate chart list called brokerage red flags or something like that, or at least notate them in your chart list, organize them in a certain way so that your attention is drawn to some of those vulnerable charts, just to make sure that you stay on top of those particular signals. Second thing would be the alert capabilities. Remember, anytime you're looking at one of these charts like BKE, if there's a particular price level that you think is meaningful, if you see the 50-day moving average is right around $57 and you say, all right, I just want to know if the thing breaks 57, below the chart there's this little alert bell. You type in the limit, the level, you type in the value, put in a note, make sure you email, text yourself, site notification. If you do that, you can't miss when something's broken down, right? A lot of times there's no excuse to just ignore the chart, right, and just not look at it. I'll give the StockCharts platform the opportunity to help you stay on top of the most important potential breakdowns. Again, I love the text message in particular because my phone lights up. I know to go in and check the chart and just see if I'm comfortable with the movement that I've observed. But the real trick, I would say, all of those things are great. For me, it's all about the scans, right? So in a scan workbench, you might want to look for breakdowns, right? So like this one that I actually did was a weekly MACD sells. This is a scan that I use that basically looks for stocks every week. I'll run a scan like this and say, tell me any of these names that have broken down. Now, this is for the S&P. You could easily put your portfolio, like a watch list, a chart list that has all of your holdings or stocks that you're watching. Have this, and this is basically the syntax that allows you to look for the MACD rotating lower. And this is using the weekly data. The reason why I'm using the weekly data, here's Outfront Media. Here's the weekly chart. I'm looking at the weekly PPO. It's pretty much identical to the weekly MACD. Here's the sell signal that we just had in the last week. Here's the weekly chart of Buckle. There's the weekly MACD sell signal. Here's GPC with the weekly MACD sell signal. This is a great scan to run on stocks that you own because it's going to find things that have been trending higher. But the weekly MACD sell signal basically means the longer term trend is starting to rotate lower, and this might be a vulnerable position, right? It's starting to come down off of that most recent swing high. So what I like to do is run this scan, and then what you can do is you can automate it, right? So you have the ability to do scheduled scans, and you can take any of the scans that you've created. You can actually say, all right, S&P MACD, weekly MACD sells. And again, assume that this is like your portfolio or your watch list. MACD sells. You can say every Friday at the U.S. market close, I want you to do this. You can either save it in a new chart list, which would basically create a new list of charts, which is what I like to do. You say save scheduled scan, and then literally every Friday after the close, StockCharts is going to send you an email and tell you, here are the stocks that fit that criteria. So again, if you're concerned about endowment bias, which you should be, if you're concerned about your ability to have the conviction to take action when the change of character occurs, which you should be concerned about that, use a platform like StockCharts. Use the scheduled scans to automate that process for you. Every week, every day, whatever makes sense, you get an email with any of the positions you might hold that might be showing vulnerability based on some of the techniques that we talked about. What do you think? What other tools do you use to manage risk? What tools on the StockCharts platform have you found most helpful? Which indicators or approaches have helped you to avoid climactic loss in your portfolio? Don't forget to drop a comment and let me know. I'd love to hear some other ideas beyond the things that we've shared today. That'll do it for today. I'm Dave Keller with Market Misbehavior. As a reminder, I have a market recap show every weekday after the close at 5 p.m. Eastern. I also have a podcast called the Market Misbehavior Podcast, where I sit down with really smart people like Mary Ellen McGonigal, Frank Capilleri, George Noble, Bob Pisani, many other fantastic educators and strategists and traders. So make sure you check out some of those recent interviews as well. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts.